All right, let's talk about one of the most unbelievable corporate meltdowns in modern history, the story of Enron. This was a company that flew so high, so fast, built on this incredible illusion of innovation, only to completely vaporize in a scandal that rattled the entire financial world. Just look at that number, $63 billion. In December of 2001, that's what disappeared when America's seventh largest company went bankrupt. Thousands of people lost their jobs, their pensions, their life savings, and Wall Street was just completely floored. Not just because it happened, but because for a little while there, nobody could really explain how.
So that's the big question we're digging into here. How did this company, hailed as the future of the economy, turn out to be a total house of cards? And maybe more importantly, why did everyone, from the smartest analysts to seasoned reporters, buy the story for so long?
To really get the collapse, you gotta go back to the beginning. Let's rewind to 1985. Enron started out as this pretty sleepy pipeline company in Houston. Their business was about as simple as it gets. They moved natural gas through pipes. It was stable, it was predictable, and yeah, it was kind of boring. But see, the CEO, Ken Lay, he had this much grander vision. He saw that the government was starting to deregulate the energy markets, and he had this one huge idea. Why not turn Enron from a clunky utility into a slick energy trader? All of a sudden, natural gas wasn't just something you burn, it became a financial product you could bet on, just like a stock.
Now, to pull this off, Lay brought in this brilliant, fast-talking consultant named Jeff Skilling. And Skilling's job wasn't just to build a new business model, it was to build a new myth. The myth of Enron as this unstoppable, hyper-innovative machine, run by, as he famously called them, the smartest guys in the room.
In this quote, this is pure Skilling. It captures his entire pitch perfectly. He wasn't just selling gas contracts. He was selling a story that was tailor-made for the times. You have to remember, this was the peak of the dot-com bubble. So he positioned Enron as a high-tech ideas factory, not some boring old energy company. And Wall Street, obsessed with innovation, ate it up. And they built this image piece by piece. They launched Enron Online, a slick digital trading platform that made them look like a tech company. Fortune magazine literally named them America's most innovative company for 6 years in a row. The vibe was kind of like Silicon Valley with a Texas swagger. But inside the company, the culture was absolutely brutal. It was all about performance at any cost, or you were out the door.
And this right here really gets to the core of it. You had these two Enrons living side by side. There was the myth, the innovative tech giant on a rocket ship of endless growth, and then there was the reality, a toxic culture built on hiding mountains of debt through some very creative financial storytelling.
So how'd they do it? How did they keep that stock price soaring when the actual business was bleeding cash? Well, it really boiled down to two incredibly deceptive accounting tricks, designed to do one thing: create the illusion of massive profits. Okay, trick number one was something called mark-to-market accounting. Now stick with me here, this is kind of wild. Let's say Enron signed a 20-year energy deal. Instead of booking the profits as they came in over those 20 years, they booked the entire projected profit for all 20 years on day one. So on paper, they looked like a cash machine, even if those deals later turned out to be complete duds.
And this quote just nails it. It's the perfect way to describe it. They were booking fantasy profits based on projections that were, let's just say, ridiculously optimistic. It was a ticking time bomb, but it kept Wall Street cheering every single quarter.
Now, the second trick was maybe even shadier. The CFO, a guy named Andy Fastow, created this whole web of outside companies called Special Purpose Entities, or SPEs. And their purpose was very simple: to act as Enron's personal dumping ground for bad debt and failing projects. Enron would sell its garbage assets to these SPEs, which made its own books look sparkling clean. Honestly, this analogy explains the scam perfectly. Enron was basically loaning money to its own fake companies so they could buy Enron's junk. It was a shell game on a massive, multi-billion-dollar scale, and it was all designed to keep investors in the dark.
For years, this whole charade seemed absolutely bulletproof. But by August of 2001, the lies were just getting too big to manage, and that carefully crafted facade was finally about to crack.
Suddenly, two massive red flags pop up at the same time. First, Jeff Skilling, the architect of the whole new Enron, just abruptly resigns. His reason? He said he wanted to spend more time with his family. Right. Then, that same month, the SEC launches an investigation into Andy Fastow's web of mysterious companies. The smoke was getting very, very thick.
And it wasn't just outsiders getting nervous. The alarm bells were ringing loud and clear inside the building. A VP named Sharon Watkins wrote this absolutely chilling memo to Ken Lay, basically predicting the entire disaster. And what happened? The warning was completely ignored.
With the truth finally starting to leak out, the fairy tale rise of Enron was about to turn into a terrifyingly quick freefall. The whole thing was about to implode.
And this was the moment the dam finally broke. In October, Enron publicly admitted to, quote, accounting errors, which is corporate speak for we got caught cooking the books. They revealed that more than $500 million in profits they'd claimed, well, it just wasn't real. For investors, this was the final brutal wake-up call.
And the stock just went into an absolute death spiral. I mean, look at this. After peaking at over $90 a share, it became completely worthless in just a matter of months. By the end of November 2001, you could buy a share of Enron for less than $1. The company had lost over 99% of its value. It was gone.
So, on December 2nd, 2001, Enron officially filed for bankruptcy. But this wasn't just a business failure. Not by a long shot. It was a systemic one. So what happened next? And who exactly was held accountable for this mess?
See, the thing is, Enron didn't do this alone. They had help. A lot of help. Sure, the executives masterminded the fraud, but their auditors, a huge firm called Arthur Andersen, basically taught them how to cheat and then shredded the evidence. Major banks funded the sham deals. And all the while, Wall Street analysts kept screaming buy to the public, often because their own banks were getting rich off Enron.
The reckoning was huge. The accounting firm Arthur Andersen was convicted of obstruction of justice and basically ceased to exist overnight. The execs went to prison, Andy Fastow got 6 years, and Jeff Skilling was sentenced to 24. Ken Lay, the CEO, actually died of a heart attack before he could be sentenced. And out of the ashes, Congress passed the Sarbanes-Oxley Act, a massive new set of rules designed to stop this from ever happening again.
But when you really step back and look at it, this whole story is about something deeper than accounting fraud. It's about the power of belief. For years, everybody wanted to believe in the myth of Enron so badly, the myth of genius, of innovation, of endless growth, that they just stopped asking tough questions.
And man, did Enron's lie travel fast. It was fueled by greed and a culture that desperately wanted to believe in an easy, exciting story. The truth, meanwhile, was buried deep in complex financial reports that nobody wanted to read. It's a heck of a reminder of just how fragile trust in our entire system can be.